How is it that two analysts can look at the same data and come to very different conclusions? Predictions for UK house prices range from big drops of 35% all the way to very small rise. Are these predictions influenced by bias and vested interest? You can easily understand why an estate agent would downplay fears of a fall in house prices, but the nature of the media also often rewards more sensationalist headlines and YouTube titles. There's a theory that the more pessimistic a YouTube video is, the better it does. So in this video, I'm going to do something a bit different. I'm going to present the case for a big fall in house prices, and then the opposite view, that house prices will not fall at all. Then at the end we can adjudicate, see which is strongest, and I'd love to hear your comments too. The case for a big fall in house prices is not complex. In 2020, a 2-year fixed mortgage worth £200,000 would cost £867 a month. But since then, mortgage rates have almost tripled, from 2.2% to around 6.4%, increasing the potential monthly cost to £1,300, an extra £500 a month, a huge burden for households. The Bank of England shows how millions will increasingly face higher mortgage payments in the coming years. And importantly, many first-time buyers are simply being priced out of the market. Demand will have to fall. Another way of looking at the situation is that for mortgage payments to return to their 2020 levels of affordability, house prices would need to fall substantially. To maintain mortgage payments at a pre-crisis peak would require a 35% fall in prices. Some may point out that in the past we had interest rates of 15–16%, so why should we worry about interest rates of 5.5–6%? The reason is that house prices are so expensive compared to income. House prices have soared in the past few decades, and so interest rates have a much greater effect than in the past. It's like saying 6% is the new 15%. What really counts is a monthly mortgage payment, and with average mortgage payments rising up to £2,500 a year, this is going to be a very real shock for both existing homeowners and those trying to buy. And the worst is still to come, as many face remortgaging in the next 12 months, and they'll face this huge jump in costs. Now, sometimes people say UK house prices never fall, but that is not true. In the early 90s, high interest rates and a recession caused 4 years of house price declines. In 2008, house prices fell 20%, and it could have been much worse if interest rates had not been cut to 0.5%, creating the massive incentive to get a mortgage we've seen for the past 14 years. And despite that crash, from the early 90s to 2022, we've seen a long boom in house prices, where the ratio of house price to incomes have soared from 2.53 to 9. Prices have become detached from affordability and incomes. And the only reason house prices have remained so expensive for so long is we had this unique period of ultra-low interest rates combined with quantitative easing, which inflated asset values. But now that exceptional period is over. House price to income ratios have to fall. To reduce house price income ratios to 5 would require a 20% fall. To reduce house price ratios to 4 would require something closer to 30%. And it's worth bearing in mind, we've seen rapid house price falls in New Zealand, Canada and Netherlands. And if we look at mortgage payments as a share of income for first-time buyers, it's forecast to reach levels last reached in previous crashes. A good question is, why did house prices only fall 20% during the credit crunch? Well, the reason was that base rates were cut 0.5%, and the Bank of England began a process of quantitative easing. Housing became attractive for 2 reasons. It was very cheap to get a mortgage, but also the yield and capital gains from housing was so much better than, say, saving accounts or government bonds. So this is why, despite low wages, house prices soared. Then during 2020, the Bank of England perhaps overreacted to the temporary economic shutdown by cutting interest rates to a record low of 0.1% and adding an extra $400 billion of quantitative easing. Households saw a surge in savings, and investors were once again attracted to investing in the housing market. And this caused the final surge in prices we saw during COVID. And it's why prices became so overvalued by mid-2022. But this climate of low interest rates is over. Since 2021, UK inflation has far exceeded its target of 2%. Now, initially, inflation was caused by rising energy and food prices, often imported from abroad. But compounded by ultra-loose monetary policy, the cost-push inflation became embedded in domestic core inflation. That's underlying inflation. And earlier this year, economists were often shocked when inflation frequently exceeded its forecasts, giving the UK the highest rate of inflation in the OECD. And belatedly, the Bank of England realised it would have to increase interest rates much more than previously expected. And this is what caused the mortgage crisis, the new rise in mortgage rates to 15-year highs. Commercial banks are now stress testing at 7 to 8%, meaning the amount first-time buyers can borrow has fallen dramatically. And this is significantly reducing the demand for buying houses. And this can be seen in the dramatic drop in housing transactions and mortgage approvals from the Bank of England. At the same time, buy-to-let landlords face a real deterioration in conditions. Rising interest rates means that those with interest-only mortgages are struggling to cover their costs. And combined with expensive government legislation and the end of easy capital gains, landlords have been selling. And even a small percentage of landlords selling is enough to tip the balance into supply being greater than demand. Zoopla recently reported how demand is falling and supply is rising, and that's a perfect combination for falling prices. And of course, as prices fall, more landlords and investors may consider selling to cash in before it's too late. And in recent months, there's been really increased pessimism about the housing market as people wake up to the structural change in the market as the low interest rate era is over. One of the big arguments that house prices will not fall in the UK is that the UK has an extreme shortage of supply. But how true is this statement? We often just take it for granted. It's often mentioned. In the past decade, the supply of housing has actually increased faster than the number of households. Previous forecasts for UK population has proven to be overly optimistic. Population growth has been lower than expected. Now, although there is a shortage of rented and social housing, according to this research from LSE, there's been a growth in excess dwellings in England, houses not occupied, with many regions having more dwellings than people. The government's own house price model suggests that even if we had built 4.8 million homes since 1997, prices would only be around 7% lower, only a small fraction of the 120% rise in real prices. Supply on its own is not going to prop up prices. On top of all the pressures on the housing market, the UK economy faces its own crisis. Economic growth is anemic, real wage growth is negative, the cost of living crisis and high inflation mean that potential and existing homeowners have been squeezed and struggling to buy or save for a deposit. And the economy is likely to get worse before it gets better. The effect of the past interest rates have yet to be fully felt in the economy. In 2024, increasing numbers of homeowners will remortgage to much higher rates, which will hit finances, lead to lower spending, and is likely to cause a recession. And a recession and rising unemployment would only further hurt the housing market as repossessions rise and people lack the confidence and ability to buy. The problem is that despite near zero economic growth, the UK is seeing really very high rates of inflation. It suggests a broken economy not working. And if a bank are committed to getting inflation back to 2%, restoring their credibility, it will cause immense pressure on homeowners and mortgage holders. Another element of the housing market equation is the £800 billion of quantitative easing that the Bank of England created in recent years. This increase in the money supply helped to inflate asset prices, and the COVID stimulus played a part in the high inflation that we see. And as quantitative easing is reversed, the excess money, which helped fuel an asset bubble, will go into reverse. So this is how we can end up with a 30% fall in house prices over a few years. A tripling of mortgage rates, a failing economy. The fall in prices won't be instantaneous, more like the early 90s where it took quite a few years for prices to adjust. So that's a case for a big drop. What about the ultra-optimistic perspective that the housing market will survive and only very, very small declines in prices before they start their long-term rise again? I mean, firstly, the housing market is somewhat different to the 90s and 2007. Mortgage payments play a smaller role as homeowners have built up more equity and have used bigger deposits. it means that interest rates have a smaller effect than in the past. The Bank of England model shows that the average mortgage debt burden will rise into 2026, but it will remain below past peaks. Also, home repossessions are nothing like the early 90s. Unemployment in 2023 is low, with record vacancies just last year. Unlike, say, 2007, there are less high-risk mortgages such as interest-only, high-income multiples or self-certification mortgages. Banks are much better capitalised than in the past, and in fact have profited quite a lot from recent conditions with rising bank spreads. Also, the high inflation we are currently seeing will itself be part of a house price correction. With nominal wage growth around 7%, this means that the nominal cash buying power of workers is rising 7% a year, and this rise in nominal wages will reduce house price to income ratios, even if house prices themselves don't fall. In the mid-1970s, the UK experienced high inflation, a deep recession, and interest rates of over 16%, all the ingredients for a house price crash. But house prices didn't fall at all. Nominal house prices in the 70s continued to rise. Now, it is true that real house prices, adjusted for inflation, did fall 20%. But the important thing is the readjustment occurred due to the inflation itself. And don't forget that in a time of inflation, buying an asset like housing is a great hedge itself against a fall in the value of money. Also, despite high inflation, it's quite possible that next year interest rates may fall quicker than some predict. In May, inflation data was much worse than expected, causing a major re-evaluation of interest rates. Mortgage rates shot up. But this week, inflation fell much more than expected, causing a re-evaluation in the opposite direction. Historically, UK inflation does closely follow the trend of other countries. The UK is something of an outlier, but it's no longer such a basket case, and it's likely to catch up with the falling inflation rates we see in the US and to a lesser extent Europe. There are many disinflationary pressures coming to the economy. The 2020 surge in money supply is being reversed. Consumers are seeing lower petrol prices. In July, the energy price guarantee has been cut. Far from a wage price spiral, UK workers have very limited bargaining power, being forced to accept real wage cuts. And as inflation falls in 2023-24, nominal wage pressure will almost certainly decline. Grocers report that the worst of food inflation is over. The fall in global food prices is yet to be reflected in headline inflation. And furthermore, the recent interest rate rises will slow down the economy, which in turn will reduce inflation even more. The point is that 8% inflation is an anomaly given the weakness of the UK and global economy. And as inflation falls in 2024 and the UK enters recession, the bank will almost certainly start to consider reversing interest rate rises. Also, it's a mistake to focus entirely on mortgages. Although important, the UK housing has seen increased demand from cash investors, parental wealth, higher deposits and foreign buyers. The role of mortgages is less in the housing market than it was in, say, the 90s. And also, the irony is that higher interest rates have caused a surge in interest income. So far, the Bank of England report that the increase in interest income is actually greater than the higher cost of borrowing. Some homeowners will find it difficult, but the higher interest payments will make the wealthy even better off. Also, it is somewhat misleading to say the UK doesn't have a housing shortage. The UK has one of the lowest rates of home occupancy in Europe, and this does have the effect of preventing or limiting house price crashes. In 2007, Ireland and Spain saw a 50% crash in prices because they built so many new homes. That didn't happen in the UK because there wasn't this excess. In the rented sector, a prolonged shortage of available lets is causing rent inflation to continue even during a housing crisis. The result is that there is still an incentive for renters to beg and borrow as much as they can to buy, and all the existing homeowners who have paid off their mortgages are often willing to lend to their children to buy, another factor propping up prices. And also worth mentioning that these days it's more common to have two household earners rather than in the past there's just one. So that can explain why there's a somewhat rise in price to income ratios. Also, the example we gave earlier in the video about the higher mortgage payments for first time buyers It can be mitigated to some extent by extending the mortgage term from 25 to 40 years. And this means that the mortgage payments will fall from, say, 1,360 to 1,190. Also, there are some homeowners who can use savings built up during COVID. And also, when we look at house price to income ratios, it's more common to have. So roughly, this is the two conflicting arguments. Who is right? Which is strongest? Personally, I tend to feel that at the moment, the strongest case is for quite a significant fall in prices. We shouldn't underestimate just how much of a seismic shift has happened compared to the past 13 years. Also, we have to be careful about reading too much into one data. The recent fall in headline inflation was welcome, but underlying inflation is still high. Mortgage rates only dropped very marginally. What about vested interest and bias? And it's hardly surprising if estate agents and those in the mortgage industry play down the risk of house price falls and prolonged higher interest rates. I'm also aware that in the other direction, in the media and YouTube, I feel there is something of a vested interest in advocating highly dramatic crashes. This is what gets most click. I used to think that the more pessimistic you are on house prices, the better your YouTube video does. But the truth is, there's so many variables at play, it is really hard to give a definitive prediction. There's definitely an element that you can choose which data appeals to you. And there's a huge range of unknowns about what will happen to inflation and growth next year. For example, a big unknown is how much will repossessions rise. That's important because if people are forced to sell, that'll have a very big effect on forcing prices down. At the moment, there's still fairly limited properties on the market. However, although there's a lot of unknowns, it is also important to say that there is this very clear increase in the cost of mortgage payments. And that is definitely going to have an effect on the market. And we can't explain that away. So although there's a lot of uncertainty, it's very reasonable to assume there'll be a significant house price correction